Good evening, everybody. I can't tell you how pleased I am to be back here in person, actually seeing all of your smiling faces instead of just talking to a blank screen and seeing none of you and hoping that maybe the video will actually work itself out. So I know from having done this for a number of years, and I know from seeing a number of your faces that there are some number of existing shareholders in the audience. I'm going to try to clip through this presentation at relatively quick speed so that we leave a bunch of time for questions. But I'm also going to try to give those of you who aren't familiar with Burford a little sense of what it is and what we do. So Burford is the world's largest specialty finance company that focuses on the legal industry. What does that mean? It means that we look to the underlying value of legal assets, claims fundamentally, litigation claims, arbitration claims, regulatory matters, you name it, for commercial clients. This is a large dollar commercial business. It's not a consumer business. We're not a slip and trip style, ambulance chasing bunch of lawyers. These are high dollar complex commercial matters. So we look at the underlying value of those claims and we provide financing against them. Sometimes we're financing them so that companies can use our capital to pay for the legal fees of taking those claims forward instead of using their own operating cash for that purpose. Sometimes we're going further than that and actually advancing capital against the value of the claim, so monetizing part of the underlying interest. We run about a $5 billion portfolio of this. All of these are US dollar numbers. We run about a $5 billion portfolio of litigation assets. We've been doing this for a dozen years. We're not only listed here in London, but also on the New York Stock Exchange. And we've been seeing nice growth, a 5-year compound annual growth rate in the portfolio of 43%. We actually had a fantastic 2021 in terms of new business, best year in our history. Notwithstanding the pandemic, we wrote more new business than we ever have, more than $1 billion of it. And that reflects what we see of as continuing market demand for our capital. And one of the reasons, frankly, for that continuing demand, in addition to the general fact that corporate clients are interested in alternatives to just paying their own operating cash for increasingly high legal expenses, is also because lots of companies got a little spooked during the pandemic about their own liquidity situation, as you all saw in the first half of 2020. And companies are increasingly taking the view that they should be husbanding their liquidity, their cash, for their operating businesses, which makes perfectly good sense, and not diverting it towards non-core activities like their legal function. I say this with some sadness. I used to be the global general counsel of Time Warner, the media group. I liked having a legal function. I liked trying to get cash out of the CFO, but it was always difficult to do. And that's probably the right choice in practical reality. We generate reasonably high and uncorrelated returns. All of our returns, all of our cash returns come from the operation of the justice system, the operation of the litigation process. So when you start cases, they go through this process, they come out at the other end, and those results have no relationship to either market activity or economic conditions. So uncorrelated returns, a 12-year track record. We've brought back almost $2 billion of cash by now. And as you can see there, we're consistently producing returns that are about 30% annualized and excuse me, 90 or so percent on a return on capital basis. In 2021, even though we had a fantastic year for new business, we had a somewhat slower year for actually bringing cash in from the cases. And certainly the pandemic played a significant part in that. You all saw firsthand the impact of pandemic delays. Courts obviously slowed down or even closed, especially courts that run cases that require jury trials, as lots of US courts do. Those simply weren't happening at the same volume. Juries sit about as close together as you're sitting in these chairs. That doesn't allow for a whole lot of social distancing in the height of the pandemic, and so you certainly saw some delays. Delays for us, unlike a number of businesses affected negatively by COVID, are just delays. This is just timing. None of our cases discontinued. No client said, gee, this is taking too long, we're not going to do this anymore. Instead, you simply have these basically creating a backlog that now needs to work its way through the courts. And so we're hopeful that as time passes, you'll see those backlogs go out. And this chart at the bottom here shows our loss rates. And again, I'm not showing you that to say how wonderful we are. We actually think the loss rates should be somewhat higher than they are right now. But the point of the low loss rates is to show that nothing bad is happening with this portfolio. It's just moving slowly. It's not that we were getting cases to the end and losing them. We simply weren't getting them to the end at all. Right now, the modeling that we've released publicly, and you can find a fair bit of detail about this on our website, right now the portfolio that we have, the balance sheet portion of the portfolio, in other words, the portion that shareholders own as opposed to fund investors, that is, our modeling is suggesting that has the potential of generating about $3.8 billion of cash realizations in the future. That would translate into about $2.2 billion of profit. We thought that a little case study of how this works and also some of the twists and turns that you can experience in litigation might be interesting. So this talks about a case that actually started in 2013. And one of the points to remember about litigation is that even when the conveyor belt twists and turns a little bit, litigation still is on a conveyor belt. It marches forward inexorably. So all of these investments come to an end and all of the investments produce an exit. We don't have to sell them. We don't have to find a market for them. They generate the outcome at the end on their own. And so this case took a while. You know, it did the normal pre-trial litigation stuff. That went okay. It went to trial. It lost. The judge made a fundamental error. It had to be appealed. Up it went on appeal. We won the case on appeal. Back down it went for another trial, which is what happens when you win the appeal and you've lost the trial. And ultimately, then there was some COVID delay in there, and ultimately this case settled last year. Even though it took quite a long time, it settled very nicely. We ended up with a 231% return on capital, a 23% IRR, despite the fact that it has been running since 2013. And so there are a few messages from this for us. One is that even though our portfolio has some stuff in it that's pretty old, that does not mean that it's necessarily bad. Sure, some of those old cases might lose, just like any other case in our portfolio. But the reality is that old cases simply mean that they're continuing to wind their way through the process. It doesn't create any value judgment about whether they're good or bad. This also shows the operation of our accounting. So when we make these investments, we hold them on our balance sheet at cost. We don't write them up by the passage of time. We only change their carrying value for accounting purposes when there is a change in the actual litigation, when there's an event, an objective event that would cause us to do something. And so these changes reflect what happens in the case. It went up a little bit when things went well. It went all the way down to zero when we lost the case, so we wrote it off. It came back to life when we had the appeal, and then, before it settled, because the case had been going very well, it got marked up somewhat, but still well below the level of proceeds that we actually generated. So it's a little case study not only of COVID delays and of the twists and turns, but ultimate success of litigation, but also the way that we do our accounting. This really highlights a fundamentally important part of investing in this asset class. So we start by looking at lots and lots and lots and lots of deals. We have quite a low acceptance rate. Typically, we look at 1,500 to 2,000 deals a year. We accept somewhere between 5 and 8% of them. And those turn into our commitments. We deploy, in other words, we send money out the door for most of our commitments, and then we're buy and hold investors. We wait to see what the outcome of the litigation process is going to be. And there are 3 possible outcomes. The most common outcome is the cases settle. And you all know this just from living in the world. You see a lot more litigation resolving by settlement than you see, high-profile trials with CEOs testifying in the witness stand. Almost 2/3 of what we do settle. And the reason that settlements are so enticing is because settlements are cash flow positive, riskless outcomes. They're riskless because you've taken the litigation risk off the table, and they're cash flow positive because nobody settles cases for zero. And so you're starting off in a diversified portfolio with a significant volume of activity that is producing strong positive returns without risk. Then you get the other two possibilities, and that's when risk enters the equation. You go to trial. When you go to trial, you can lose. The judge may well, the jury may well take a different view of a case than we or our clients do. But when we go to trial and win, which as you can see happens a fair bit more often than losing, we make a lot more money. We make 5 times as much money when we go to trial and win as we do when we settle. And so if you combine those two dynamics, the settlements and the gains, and subtract the losses, and these numbers are all on a pure cash basis, you end up with the returns that I cited earlier, and that's now across a $1.9 billion track record. The other thing that makes this asset class interesting is its fundamental asymmetry. And again, this is common sense. Because there's litigation risk, if you've got a case that's going to cost $20 million to bring to trial, you're not going to spend $20 million only to try to win $20 million. You're going to spend $20 million only if you can win a good deal more than $20 million. Common sense, basic economics. What that means, though, when you project that into an investment case, is that when we lose considerably less, that's here on the left, than when we win, which is on the right. We can win a significant multiple of our investments. And we do that repeatedly. It's part of the fundamental model of litigation. This is our historical distribution, but it's also the kind of distribution that you would expect as a lawyer looking at a pool of cases. This isn't unique to Burford that we manage to have some outperforming wins. And indeed, we've got 26 of them now. 26 separate cases over time have produced more than a 200% return on invested capital. I referred earlier to the modeling output from our portfolio, and this is just a little bit more detail about this. And there's more detail yet in our investor event slides from November of 2021, which also gives you some detail about how we do this and the kind of back-testing accuracy that we've been able to provide in the past. But basically what you see from this is that as we deploy capital and as we wait through the twists and turns of the litigation conveyor belt, the probabilistic modeling that we do internally, which historically has had quite high degrees of success, of accuracy, yields these kinds of outputs. About a $3.8 billion cash recovery from the investments, resulting in about a $2.2 billion cash gain. And on top of that, another $400 million or so of asset management fees. Now, the question, of course, on your lips is, well, that's all very nice, but when? When does that come? And that's the trickier part of this. There is period-to-period volatility in our business, as we displayed in the 2021 realization slide that I showed you. And it is also very difficult to predict the duration, the timing of litigation outcomes. That is, of course, the benefit. That is what makes it uncorrelated, because we are subject to the individual calendar of the courts and the individual activities of individual judges. And so I can't take this and model it nicely for you and put it on a calendar and say, well, this quarter we think this much will come and next year we think this much will come. All we can do is say what we think the total portfolio potential is. We have running right now a particularly large case that attracts a fair bit of investor attention. Sometimes it's called Peterson, sometimes it's called YPF. It's a case against Argentina and YPF, which is Argentina's state-owned energy company. And it relates to what is now a 10-year-old expropriation by Argentina of a majority interest in YPF shares, which were publicly traded on the New York Stock Exchange at the time. The deal with YPF was that if Argentina wanted to retake control of the company, which it's entitled to do, it's a sovereign government, it can take assets just like the British government can take your house and put a highway through it, as long as they pay you for it, but Argentina had to pay. There was a formula agreed about how much Argentina would have to pay for the minority shares to force them to tender. And what did Argentina do? It simply didn't pay. And so we have been not only financing but also organizing the case against Argentina for some time, and we are right now close to the end, after many years of discovery and in intermediate legal proceedings. And so we're all done with most of the case, and we're entering next week a phase called summary judgment, where the parties will file big motions to the court, will exchange several rounds of those, and then ultimately the court will hold oral argument, probably decide those motions that might completely resolve the case, or there may be some issues that are sent off to trial. So you're going to hear a bunch about YPF in the press and in the analyst coverage of Burford in the months to come, because this is the first time that people for several years are going to see what's actually going on behind the curtain in this case. And this is a large case. The damages in issue are multi-billion dollar, and Burford's entitled to a significant share of them if it's successful. As with any case, there's risk. We could lose this case. But we've already done very well in this case to date. In fact, we've already sold a portion of our interest in it for $236 million in cash, which we get to keep regardless of what happens in this case. And so this is something that you'll see, if you're following Burford in the market, you'll see noise about it. I would say one important thing about reading legal papers, if any of you are so brave as to give these a try. So on the same day, our client will file their papers, the other side will file their papers, and if you pick up ours and read them end to end, you're going to say at the end of that, wow, this is fantastic, this is a great case, there's no way for it to lose, and my gosh, it's going to make a gazillion dollars. And then you'll read the other side's papers, and when you get to the end of those, you'll say, oh my God, this is a terrible case. There are 22 different ways for it to lose, and I can't imagine they ever invested in it. And of course, neither of those things represents the true reality, but you're just going to have to take with a grain of salt what happens over the next few months, especially because we do not talk about the substance of cases when they're ongoing. Judges really, really don't like that. And the last thing we want to do for the sake of simply talking to the market is make the judge who's going to actually decide the money really unhappy. So we don't talk about the substance of cases, and we let that just float until anything else happens. And in terms of liquidity and cash, we're in a very robust position. We had more than $300 million of cash on the balance sheet at the end of the year. As some of you may have noted, we are in the market even as we speak, raising a significant further bond issuance to augment our liquidity. I see heads nodding in the back. So you'll hear more about that later this week, I would think. And on top of that, we've got some receivables at the end of the year, some number of which have already been collected by now. So we're in a very strong position to be able to finance our future growth and to meet all of our obligations under further cases. And this is just a little snapshot of what our leverage looks like. This is not a levered play. We don't believe in putting a lot of leverage on this business. You'll see on the bottom left, this is probably the most stringent covenant that we're subject to. We've voluntarily agreed to a 0.5x net debt to tangible assets covenant, so very low leverage, and we're well below that. We're at 0.21 times right now. And so we'll always stay well below that covenant. So in summary, and before I take your questions, we had a great year this year. We're really thrilled with how much new business we were able to write, and how market adoption of legal finance is going. Even in a slower year, we generate a lot of cash. In 2021, we generated more than enough cash to cover all of our operating expenses, all of our financing costs, and do some reinvestment in new cases. And in more robust years, we generate still more cash. We take that cash and we reinvest most of it. We do pay a dividend, not as large a dividend as many of you would like. But the way we decide on dividends is we survey a wide swath of our investors, and there's a pretty wide range of views that range from, gee, we'd like a large dividend, to gee, we'd like no dividend at all. And we try, and the board tries, to come to a triangulation of what will make the largest number of people content, or possibly the smallest number of people unhappy, depending on how you want to look at it. And that's how we approach dividends. But because we have the opportunity to reinvest our capital in high returning assets, it seems sensible for us to do that. And then we'll see what happens this year as COVID continues to recede, as courts come back to normal, as you get more information and progress about the YPF Peterson case. and we're excited about the market potential that continues to exist here in a large and still relatively unaddressed market. And with that, I'd be delighted to have any questions that any of you might have.
Christopher, thank you. Again, if you want to raise a question, please raise your hand and I'll bring a microphone over. I'm going to come to you first. Hold the microphone if you don't mind. So we just don't swap hands all the time.
Okay.
Yeah.
Sure, thanks. Thanks very much. In your last throwaway comment, you talked about the courts getting back to normal. I mean, if we think in terms of court system operating throughput, pre-pandemic as being 100, where roughly do you think we are now, and how quickly can we get back to 100? And do you think they might even invest in some increased capacity to get better than 100?
So the question of court delays in COVID is a little bit more nuanced, because there are really two kinds of delays that COVID caused. One was a delay in the litigation process. So when you file a lawsuit, the first thing that happens is lawyers spend a lot of time with documents and witness testimony and so on. And so what was happening in that process was people were saying, oh, we can't do this. I can't go to my office, I can't fly, I can't collect my documents. And judges, by and large, were being lenient about that. You didn't have judges saying, wow, you must go to the office anyway, despite your fear of getting COVID. So that caused a lot of the delays. So the Peterson case, for example, had about a year of COVID delay. Those are largely abating because, as we can see, we're back together in person. You can travel, you can go to your office. And so that really, unless we get another disruptive variant, that I think is largely a thing of the past. The other kind of court delay is the fact that courts simply reduced their throughput of cases, as you said. That is slowly coming back to life, but the thing that is significant here is back to that point about settlement. So it's not just that we need all these cases to actually go to trial. The thing that makes people settle is the risk of going to trial. That's the catalyst. And so once you start that treadmill speeding up a little bit, you'll also see people starting to settle their cases instead of just sitting there, because there's no impetus for them to do that at the moment. So I don't have a number on a sort of logarithmic scale of 0 to 100, but I can tell you, and the case study that we put up there is an example, where judges, pushing cases to move through the process because they're sensitive to the backlog. And so I think 2022 will be better than 2021, and 2023 will be better still.
Question here, please.
Yeah, thank you. You just answered the question I was going to ask first one. But second one, you mentioned that obviously you don't talk about cases that you've got in flight. But I noticed, for example, your case study there, 2013, that is settled and resolved. Yet it's a matter. You haven't actually specified what the case was about. Could you not talk a bit more about the cases that are resolved and settled and done?
So we do give some case studies from time to time, and in our annual report there's more detail about that case, including the fact that it was a commercial contract case. It was basically a financial institution that had cut off credit, cut off funds for one of its clients. In an effort, the allegation was to fraudulently take its know-how and its business and start doing that line of business itself. And that ultimately was something that seemed to have some resonance in the court case. However, the fundamental issue with talking about cases is that we're the finance provider. The cases belong to the clients. And clients don't like talking publicly about their litigation matters, just as you probably wouldn't if you had one. And so the reality is it is incredibly rare for clients to give us permission to talk publicly about their cases. So when you find cases that we're doing publicly, it's generally because there's some disclosure obligation. Some company has a public disclosure obligation to say that they took capital from us. But we're unfortunately constrained from being able to do anything more than that.
Next question. Just coming to you at the back here. I'm going to hold this if that's okay.
Chris, thank you very much for coming to see us. It's incredibly appreciated. I was wondering, am I right in thinking that perhaps the raising of third-party funds has been a little bit harder, a little bit slower to come by than you would like? Or?
No, actually, quite the opposite. But there are 2 points to make there. One is we actually have really good access to third-party capital should we want it, and let's come back to that in a second. So, for example, we just raised a $360 million fund 2 weeks ago. That said, The question really is how much we want it. The difference between our business and, let's say, a hedge fund is if you pump a lot more capital into a hedge fund, the hedge fund, in most cases, can simply go and increase its position size. So fine, it likes BP, so it's holding $1 million of BP, it doubles its size, now it holds $2 million. Not a lot of extra effort or work, not the need for a whole lot of extra infrastructure. We don't have that scaling opportunity. The litigation doesn't grow infinitely. Most litigation cases are not multi-billion-dollar cases. They're tens of millions of dollar cases or hundreds of millions of dollars cases. And so when we use third-party capital for those cases, we're paying a very high implied price for the capital. If you think of the traditional investment fund structure, you know, the manager, which we would be, is keeping 20% of the profits, and the capital providers, the investors, are taking 80% of the profits. When we do on-balance sheet investing, which we fund with much lower costs of capital, the numbers are effectively reversed. We keep for investors about 80 cents on the dollar profit, and we only pay about 20 cents on the dollar for capital. And so we have actually diminished our use of third-party funds, especially in the higher returning situations. And you know, the one thing about Burford that you may find interesting, you know, Burford is a founder-run business. John Malone and I founded this business 12 years ago. We still run it. We own close to 10% of it. The management team owns yet more. And so we're very aligned in interest with equity shareholders. The way that I will hopefully make money here is by making the share price go up. That's our principal long-term goal for the business. And so we're more focused on that, on maximizing shareholder value and profitability than on any other dynamic.
Another question here, sorry, excuse me. Yeah, come sit next to you.
Just basically a couple of questions, really. One is why you're in London, not New York, because I don't see any logic in why you've chosen London. When do you recognise income? Because in my experience, the hardest part of this is actually screwing the cash out the business after you get the court to say it's yours.
Well, to the second question, that's a really, really, really important point. And it's something that some of our competitors have done not so terribly well. We have a close to effectively a 100% rate of recovering the cash once we've won the case. And the reason for that is that we do an awful lot of front-end diligence on that very issue. When you think about investing in litigation, you probably think, well, gee, is it a good case? And that's, of course, an important question. You don't want to invest in bad cases that you're going to lose, but that's only the beginning. The question then is, how much money is a court going to award, and are you going to be able to get your hands on it? And that's why, for example, you know, it's not because Russia's in the news today. We've never done business in Russia. We've never done business in the Ukraine. We've never put ourselves in a position of needing to go into those countries to take assets out of them because we don't find the court systems there reliable enough to do that. Now, why are we in London? Well, we're in both. We have, you know, if you think about the geographic distribution of our portfolio, the US is the largest market for us. We're sitting with about $1.4 billion of direct US matters, but we're also sitting with about $1 billion of English and Western European matters. So we're in both places. We have offices both in New York and London. I live in New York and spend more time there than I do in London, but I certainly come to London. And London has a special place in our hearts because when Burford was started in 2009, London was the first place that we raised capital. And the reason for that was twofold. One is we were small, probably too small to raise capital on a US market. The other is that England had recently changed its rules about law firms being able to go public. And so investors in the UK were more receptive to the idea of law as a business than they are in the US, where that still today is not allowed.
We've got time for one final quick question. Gentleman here.
So let's assume that if Burford wins the Peterson case, how likely do you see making or actually realizing the case into money?
Well, I think the same answer, because you don't go into these cases without believing that you're going to be able to collect it. Otherwise, all you have is a fancy piece of paper to put on your wall. I think it's important to remember even though people look at Argentina and say, oh, there's a bad actor, they default on their sovereign debt, the debt's not trading very well, we're outside of the sovereign debt world. We're an independent actor that can go and enforce a judgment against assets anywhere we can find them. And Argentina has a long history of a strategy where they do bad things, they litigate for a long time to try to avoid any consequences, they lose a lot, and then after they lose, they pay. And so Argentina, in fact, does not have any significant backlog of unpaid judgments and awards. And the reason for that is Argentina has a fair-sized economy and is a global market participant. And so ultimately, you put enough pressure on them and presumably you bring them to the table and you negotiate a settlement. What Argentina tries to do historically is use this process to discount down the settlement value. So that's probably the strategic game in play here. So with that, thank you very much, everybody, for this time. It was great to see so many of you in person. I'm so thrilled to be back live. And thank you to the Shares team for continuing to host this.